Let's track a single transaction. A client decides to invest 1 lakh rupees into the financial markets. Before that capital can buy a single stock or bond, it must pass through a structured regulatory architecture designed to protect it. The law positions the mutual fund distributor as the mandatory gateway for retail capital entering the system. To operate this gateway, a distributor must hold specific monitored credentials, an AMFI registration number, or ARN, and an Employee Unique Identification Number, or EUN. Holding these credentials legally binds the distributor to the AMFI Code of Conduct, establishing a fiduciary duty of care to the investor. Processing this initial 1 lakh rupee transaction depends on the distributor first proving that the chosen investment aligns with the client's financial suitability. Once the capital clears the distributor, it enters the fund. In India, a mutual fund is legally established as a trust under the Indian Trusts Act. This chart maps how that trust is structured. At the top is the sponsor, the promoter who provides the initial capital to establish the fund. Directly below the sponsor are the trustees. They act as a firewall, holding the primary fiduciary responsibility to protect the unit holders. To handle day-to-day investing, the trustees appoint an asset management company, or AMC. They employ the fund managers and analysts who decide where your 1 lakh rupees goes. But the AMC does not hold the money. That job belongs to the custodian, an independent entity that physically and electronically holds the actual securities. Notice how the line of custody bypasses the AMC entirely, which brings us to a critical question. If you invest your capital and the asset management company goes bankrupt, what happens to your money? The assets remain safe. The AMC never held them. They are secured by the custodian and overseen by the trustees. This legally ring-fenced architecture isolates the investor's capital from the operational risks of the fund house itself. With the structural safety established, the distributor's next job is to match the investor's capital to a specific scheme using standardized disclosures. This diagram outlines the mandatory documents. First is the Scheme Information Document, or SID. It details exactly what the fund will do with your money, covering the investment objective, asset allocation, and fundamental attributes. Next is the Statement of Additional Information, or SAI. While the SID focuses on a specific scheme, the SAI applies to the entire fund house, containing the statutory and operational data of the AMC. Finally, we have the Key Information Memorandum, or KIM. This is the condensed summary of the SID and SAI, and it must legally accompany every application form. These documents enforce categorization rules set by the regulator, SEBI. If a document labels a fund as a large cap fund, it must hold a minimum of 80% of its assets in large cap stocks. To make the risk profile clear, every scheme must display a riskometer. This visual tool communicates the specific risk level of the principal investment, ranging from low to very high. These 3 documents and the riskometer reduce information asymmetry, showing the investor exactly what their 1 lakh rupees is funding before the transaction executes. Once the capital is committed, it is converted into ownership of the fund via the net asset value, or NAV. This graphic shows the NAV calculation. Take the total value of the scheme's assets, subtract the liabilities, and divide that number by the total outstanding units. As new investors enter the fund and existing ones redeem their capital, that denominator, the outstanding units, is constantly expanding and contracting. Because this pool is dynamic, SEBI enforces fair valuation principles. The NAV must reflect current market realities, not the historical prices at which the fund originally bought its assets. This is achieved through mark-to-market. At the end of every trading day, the portfolio's assets are revalued based on their closing market prices. Daily mark-to-market calculation is the mathematical engine that prevents pricing arbitrage between the investors entering and exiting the fund on any given day. Because of mark-to-market valuation, macroeconomic policy shifts are immediately priced into the investor's NAV. Consider this scenario. The central bank suddenly announces an increase in interest rates. What happens to the NAV of an existing long-duration debt scheme in this situation? The NAV decreases. This animation illustrates the core financial logic. When new interest rates rise, the fixed yields on existing bonds become less attractive. The price of those existing bonds must fall to remain competitive, pulling the fund's NAV down with them. Understanding this inverse relationship allows a mutual fund distributor to manage client expectations regarding daily NAV volatility. Eventually, the life cycle reverses. When an investor exits, they surrender their units back to the AMC in exchange for capital, calculated at the applicable day's NAV. But the total NAV value isn't necessarily what hits the bank account. First, the fund may deduct an exit load, a time-based penalty designed to discourage short-term speculation. This matrix breaks down the next major deduction, capital gains tax. The rate applied to your profit is determined by your holding period, categorized as either short-term or long-term, and the underlying asset class. There is also a second potential outcome during the life cycle, income distribution cum capital withdrawal, or IDCW, formerly known as dividends. IDCW can only be paid out of the distributable surplus generated by the scheme. When that payout occurs, it mathematically reduces the NAV of the fund by an equal amount. The final amount deposited back into the investor's bank account is the exact result of the exit NAV, minus any applicable exit loads and capital gains taxes. After the investor's capital is finally returned, how do we objectively judge if the asset management company actually performed well? To ensure standardized reporting, SEBI mandates a specific standard for performance evaluation, the Total Return Index, or TRI. This chart shows why SEBI requires the TRI instead of a simple price return index. The higher line, the TRI, accounts for both capital appreciation and the reinvestment of dividend yields, providing a more accurate baseline to compare against the fund's actual returns. The industry operates by balancing transparency through the SID, legal firewalls via the trust, and mathematical fairness of daily valuation. Professional fiduciaries must master these underlying mechanics to manage the life cycle of a trade. Tracing the journey of capital, from the initial profiling to the final tax-adjusted return, defines the mutual fund distributor's mandate.